The Basel Accords are a series of international regulatory agreements that set the standards for bank capital adequacy, stress testing, and market liquidity risk. In this video, we'll take a closer look at the history of Basel regulations, Basel I, changes in Basel II, Basel 2.5, Basel III, and the latest Basel IV, with some examples and comparison charts. Basel I, also known as the Basel Capital Accord, was introduced in 1988 by the Basel Committee on Banking Supervision. Its purpose was to ensure that banks maintain adequate capital levels to absorb unexpected losses. Under Basel I, banks had to maintain a minimum capital ratio of 8%, which meant that for every $100 in loans, banks had to have at least $8 in capital. However, Basel I had several limitations, and in 2004, the Basel Committee introduced Basel II to address these limitations. Basel II introduced more risk-sensitive capital requirements and stress testing for banks, which meant that banks with riskier portfolios had to hold more capital. Basel II also introduced a third pillar of regulatory requirements, which focused on market discipline and transparency. Basel II differentiated capital ratios based on the risk profile of the bank, and introduced three pillars of risk-weighted asset categories: credit risk, market risk, and operational risk. Overall, Basel II was an improvement over Basel I in terms of risk sensitivity and differentiation between different risk profiles of banks. Basel II also introduced more emphasis on market discipline and transparency. However, the global financial crisis of 2008 exposed further limitations of Basel II, and in response, the Basel Committee introduced Basel 2.5 in 2009. Basel 2.5 introduced stricter requirements for banks to hold more capital against their trading activities and securitization exposures. One of the main differences between Basel II and Basel 2.5 is the treatment of credit risk. Basel II relied on external credit ratings to determine risk weightings for assets, which were criticized for being overly reliant on ratings agencies. Basel 2.5 eliminated the use of external credit ratings and introduced an internal ratings-based approach to determine risk weightings. Another key difference is in the treatment of operational risk. Basel II allowed banks to use either the basic indicator approach or the standardized approach to calculate operational risk capital requirements. Basel 2.5 introduced advanced measurement approaches, AMA, which allowed banks with more advanced risk management systems to use these systems to calculate operational risk capital requirements. Basel 2.5 also introduced additional capital buffers, including a capital conservation buffer and a countercyclical buffer. These buffers were designed to ensure that banks have enough capital to withstand periods of financial stress. Finally, Basel 2.5 introduced a leverage ratio as a non-risk-based capital requirement. The leverage ratio is calculated by dividing a bank's Tier 1 capital by its total assets, and is designed to provide a simple measure of a bank's leverage.